Welcome back to FT Markets. It's been a turbulent week in Greece, particularly in the financial markets, with sharp falls, especially in Greek bank stocks. With me to discuss what's been going on is Christopher Thompson, who's my colleague on the FT Capital Markets team. Chris, just if we look at our first chart, we can see just quite how dramatic the fall in share prices has been since the election of Alexis Tsipras as the Greek Prime Minister at the weekend. Sharp falls across all the four major banks. Just why, and bigger than the stock market in total, bigger falls than the stock market in total, why are banks faring particularly badly?
Well, the investors in banks, and keep in mind that these very same banks barely 6 months ago borrowed enormous amounts of money from investors keen to get some pickup, and what they saw was a eurozone recovery story.
A real mood swing since then.
Indeed, and what's happened is that you've had two things. You've had deposit flight, both from companies, but also now increasingly households taking their money out of the banks, and then at the same time in the interbank markets, foreign banks want to minimize their exposure to Greek banks at the moment.
So basically, investors worrying about the fragility potentially of Greek banks, despite all the steps that were taken to strengthen them prior to the election at the weekend.
Absolutely, that's the case. They are facing a liquidity crunch and are likely they are having to tap the emergency liquidity assistance facility
from the European Central Bank.
Indeed, and the National Central Bank.
As our chart also shows, there's been quite a bounce back already today, actually. Is this situation containable, do you think?
Well, I think it's indicative of the volatility that we can expect as the government goes into negotiations with its eurozone creditors. I mean, we've seen this week we've seen 3 days of consecutive double-digit falls for the banks, and today we have seen a bounce upwards in the double digits, but they've still overall.
If we look at our second chart, we can also see the impact on Greek government bonds has been pretty steep as well. A massive increase in their borrowing costs if they were back in the market tapping global investors, which obviously they're not. But it depends, crucially, I guess, on whether they're able to manage this sort of game, if you like. Game's a sort of light-hearted word, but there's quite a serious conflict between Greece and its partners, and whether the situation can stabilise.
Absolutely. I mean, they're playing with fire in a way, because the harder line they take rhetorically against their eurozone creditors, it obviously then damages the banks. So, but at the same time, the other side, the Germans and the creditors and so on know that, they don't want Greece to be a bad example which later infects the rest of the eurozone.
And so the banking system is where the first place would see problems.
Indeed, indeed. So it can spread quite quickly, although to date, the problems with the Greek stock market, but in particular the Greek financial sector, which has borne the brunt of the electoral fallout, has been limited to Greece.
Yes, well, that's a striking point, isn't it? Why hasn't it spread to Italy, Spanish stocks? Why haven't we seen these sort of contagion effects, which we always got at the height of the eurozone debt crisis? A simple reason?
Well, I mean, the simple reason is that their governments are not threatening to not pay the bills to their eurozone creditors, and the European Central Bank has created various backstops for eurozone banks in case they face a liquidity crisis.
And investors think that maybe Greece is manageable on its own.
There is a thought within the markets that they've kind of said, well, even if the worst was to happen, then the rest of the eurozone can kind of go on quietly, more or less, without Greece. Although there are critics who say there's a lot of complacency, and actually, if Greece were to take some kind of sudden decision to leave, that would indeed have a contagion effect throughout the eurozone financial system.
Chris, we're going to have to stop there. Thank you very much. So, quite sharp falls bank shares in Greece. Sharp rises in Greek borrowing costs, but we haven't seen contagion effects elsewhere in the eurozone, not on a massive scale.